Welcome to the Value Investor TV podcast. This is a podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari. This is episode 29. Episode 29, price to free cash flow in more detail. In the previous episode, episode 28, we talked about price to earnings in detail. In this episode, we're going to talk about price to free cash flow. They're relatively similar concept. It's price, how much you pay for something, divided by how much is the company generating.
Yep.
And it's a multiple of 5, 6, 7, 20, 40, whatever the number is for that company. Okay, so let's dive deep into what price to free cash flow is about. Before we move on to some of the more finer details, let's first define it. Price to free cash flow. What does that mean, Hari? How do you calculate price to free cash flow?
So let's define free cash flow first so that we can do price to free cash flow.
Yep.
So free cash flow is the operating cash flow minus your capital expenditures. So we've talked about this several times, especially in the financial statements under the cash flow statement. So it's operating cash flow is the top of that is the cash flow from operations. You get a number called operating cash flow. And then below that, you have capital expenditures, which is investments in, also called investment in property, plant, and equipment. Those two numbers are readily available. But what you would be careful about is this is really about maintenance capital expense, right? Because companies invest in free cash flow, also invest in growth capital expenditures. So you want to use the maintenance part of it because the growth is a something else entirely, right? And the idea here is that you're looking for the number that you're getting out of this is how much money does me as an owner keep in the business long term, right? Because if I own a business, what I care about is the profit from the business, right? And the profit from the business is measured in how much I can take away from the business without it affecting the day-to-day operation. So that's hence the maintenance part of this is I have to maintain the business. Otherwise, eventually the business will fall apart if I don't keep the maintenance going.
Yeah.
So that gives you the free cash flow. And if you're still confused, I'd go listen to the financial statements lecture again, and then you're now going to take the price like we did in the last episode. The price is on a per share basis, so it's the market cap divided by the free cash flow, right? So price to free cash flow per share, which is essentially free cash flow divided by the shares outstanding, or market cap divided by the total free cash flow for the company. So those two numbers give you, and this is also on an annualized basis, just like the PE, and theoretically, you could do trailing 12 months and, forward price to free cash flow and all that stuff.
But usually reported in an annual.
Yes.
Yeah.
Yeah. So now let's, we don't need to rehash all of that stuff about forward and trailing and all that. But what I would say is let's look at it more from a perspective of what is a good number to actually look at, right? So when you look at a private business transaction, right? If I went to you as you run this hot dog stand that we've been talking about for a while, private businesses tend to go for 7 to 10 times earnings, 7 to 10 times free cash flow, right? The idea is that there's a payback time of if I buy this business from you, I will recoup my investment in 7 years, right? 7 to 8 years, 7 to 10, something around that time. That's assuming that the business doesn't grow at all, right? I'm just taking the money out of the business from operations and just paying myself back, right? That's the payback time, right? And so 7 to 8 years is reasonable. So when you see a tech company that's saying 40 times earnings, 100 times earnings, 200 times earnings, right? If they don't continue to grow, then you have to it'll be 200 years before you're paid back, right? Which is ridiculous, right? No, I mean, that effectively means you're never going to get paid back. Now, so that's why they're assuming there's going to be a significant amount of growth into the industry, right? But growth is hard to measure, and growth is hard to know how long it'll take before you get there, right? So ideally, in an ideal world, the higher the PE, the higher the growth rate, and then you can justify it, right? But that's not how it works in the real world, right? There are 3 years from now, we may be in a recession, and so that may wipe out all of your, things. So you want to have, like we said before, a significant margin of safety, right? So how do you measure that? Well, typically you want to, one way to do this is to flip the free cash flow to price to free cash flow on its head and call it the free cash flow yield, right? So free cash flow divided by the price should give you a percentage. And in real estate, they use, what's called like the 10 cap method. So 10 times, if you get a 10% yield, that's a great bargain in real estate, right? So that means that you're essentially trading at, a price to free cash flow of 10. Or if you flip the yield, it's 10%. So why would you want, that number essentially tells you that you're getting 10% of your money back, and if the yield is higher than that, that's even better, right? So you want a margin of safety on that yield. So if you can get a price to free cash flow of 5 or a yield of 20, in the inverse of 20%, that's fantastic, right? I mean, that's beating the market right there.
By a large margin.
Yeah. So, right, if the market can return about 8 to 10% a year, which is what the S&P 500 index fund will return, then you want a price to free cash flow, of less than 7, so which will give you a yield of like 12% with a margin of safety, right? So that's the thought process that should be going through your head is, if I know that the S&P 500 will give me 10%, and I can't find a company that, can yield me better than 10% on my money, then I should just put my money in the S&P 500, right? Now, if I can find it, then I need to also make sure that there's a margin of safety. So if I've made any mistakes, that I'm covered, right? And so that's why you want to look for a yield of, price to free cash flow of 7 or less, because what you're looking for then is a yield of 12 to 15% or more, right?
Yeah. So that's a really interesting way to kind of flip itself on its head and look at it that way. I want to touch on, because we talked about price to earnings and price to free cash flow, I think this could be a good place to talk about why you want to use perhaps free cash flow over earnings or earnings over free cash flow. Tell us about that, Ari.
Yeah, so I would say that inherently both are flawed. Like, you're not going to be able to pick one or the other as a sole example, right? Mm-hmm. But there are actually companies out there who have positive earnings and negative free cash flow. Yeah. And that's because they have to put so much money back into the business just to maintain it, right? Mm-hmm. And that's not covered in earnings necessarily, right? And then there are other businesses that generate tons of free cash flow that have very minuscule earnings, right? And that's, because of the cash accounting nature versus the accrual-based method of accounting, right? And so you want to make sure that both of those are, understand why one could be low and one could be high, and then make sure that you understand why that those discrepancies exist. Mm-hmm. More often than not, they are pretty close to each other. Right. But earnings can be manipulated. Free cash flow is a little bit harder to manipulate, but it can be manipulated, but not as easily. Right. Right. And that could be because free cash flow, the easiest way to manipulate it is to underinvest in your own business, right? Saying that you're generating more money than you should, but you're not actually replacing failing equipment, and then people stop coming to your store because it's shabby or that kind of thing. So you do have to maintain it, right? And that maintenance expense has to be adequate, right? As a percentage of,
net sales or whatever.
However you would measure it, you would want to look at it historically and make sure that so that tells you something different than what earnings tells you, right? Mm-hmm. And so earnings could be manipulated in multiple different ways with
I think especially by quarter.
Yeah, quarter by quarter, shifting sales, that kind of stuff.
Yeah. If you want to hit like a guidance target of whatever, you can just shift that number to the next quarter or this quarter. You can expedite the process.
Yep.
Put it in this quarter, the next quarter, and the PE just changes over time, just like that.
Right.
Yeah. So important to smooth out your calculation by taking into account multiple quarters and perhaps multiple years.
Yep.
For both price to earnings and also price to free cash flow.
Yeah, and I would also say when you do the free cash flow, when you measure maintenance CapEx, a good way to do that is to average out multiple years of capital expenditure.
Yeah.
Because then that tells you maybe you don't have to spend as much every year, but so some years it's lower, some years it's higher, but it evens out when you average it all together.
Right. I think this is kind of your point about your maintenance capital in the free cash flow calculation. It goes back to one of our questions in the checklist, which was, does the company require a lot of capital investment to maintain its business? And that's essentially going right to the question of our checklist. That's essentially you want a business that doesn't have to invest so much of their cash into maintenance. Mm-hmm. Because at the end of the day, as owners, we want to retain as much cash as we possibly can without having to deteriorate the business. And if you're having to put a lot of your money into maintenance, that's not a good business to be in.
Yeah, and what I would say is it may be a bad business, but it may be okay if there's a significant margin of safety, right? If I can buy it for 3 times earnings, okay. I mean, it's
right.
I have to put my money back into the business, but does it still generate enough cash flow to justify it, right? And the justification occurs at the valuation level, right? They're still generating enough free cash flow for me to justify that. Mm-hmm. Whereas a tech business may be able to justify a higher valuation just because they have less in the way of maintenance capital expenditures.
I think perhaps this is a good point to talk about kind of two different. We can lightly touch on this, and maybe we'll do an episode on this. Lightly touch on different types of value investing. Like we talked about, we can find a great company for a relatively cheap price. That's a long-term hold, maybe a forever hold, possibly.
Yep.
And you can find a company that's not as great as the one before, but the valuation is so attractive that it might be a 3-year hold or 5-year hold, or maybe a year or 2-year hold, and then you just sell at the end of that when the valuation reaches a good level.
Correct, and that's an important distinction in valuation and value investing is, when you go through your checklist, you need to know what type of business you're owning, right? Is this a great business that you can buy and hold forever, or is this and by forever it may be 5 years, 10 years, or is this a business that once it reaches the valuation discrepancy that is breached, that you're done with it? Like you don't go and you just sell it off and then there's nothing else to be had from it, right? And so that's an important thing to think about when you do this, is that those cheap businesses that are not necessarily all that great, you buy, you hold it, then the PE goes from 5 to 10, and you say, well, I can't reasonably expect it to go from 10 to 20. I'm just done with it, right? And then you dump the stock. Yeah,
exactly. All that to say that these valuation metrics could get you there. The free cash flow, price to free cash flow, price to earnings we talked about in the previous episode. Again, to Hari's point, we don't want to simplify everything down to a single number, but this is a good entry point into your valuation calculation.
And I think if you're, Becco and I are both scientists, and so we think in, or at least I'll speak for myself, I think in precise, kind of measurements. And valuation is not a precision argument, right? It's not a precision instrument to where you can, determine the value accurately, right? Because the value is constantly changing, and the value is somewhat amorphic, right? There's reasonable estimates that you can make on assumptions and things like that. So if you're listening to this and you're like, yeah, but what formula do I use to just nail this down, right? There isn't one, right? And so you have to get over that fact that cheap is a term not defined well with precision, right? And so you're going to have to find that it's cheap. What is the actual value? Well, it's between some number and some number, and I'm going to be paying 30, 40, 50% less than the valuation on a conservative basis.
Yeah. Yeah. More and more I do this, I realize this is really more of a, I think investing in valuation exercise, a lot of it is storytelling with numbers. You have these numbers and you wrap these numbers with stories around it and try to make a story out of it. And I think the art part of it is certainly hard to master, I think.
Yeah, because I think once you start, there are certainly people who come at this with a quantitative mindset, and they will tell you they're a quantitative hedge fund and all of that stuff. And I would say that's great. What are your rate of return? Oh, it's the same as the index fund or lower?
Or lower in many cases.
Then you're probably not doing it right? And I would say that valuation is not a quantitative thing, right? It is in some regard, which is why you have ratios and things like that.
It's important to have the quantitative down.
Right.
Though. Yeah.
Yes, correct. I shouldn't say it's not it's irrelevant, but there's an art to this, which is something that's harder to measure, right? When measuring is the management open and honest,
how do you measure?
What's the number that you apply to that?
Yeah, what's the formula?
Yeah, and so when you measure how stable are future cash flows going to be, that's not a metric. That is not a numeric thing that I can quote to you and say that they are stable or they are unstable, right? You have to start using the art part of this to identify that, and that is something that comes with experience.
Yeah.
And then there are some things that come with common sense, right? And so you have to kind of think about it as, what do you know about the world, and then expand your knowledge of the world, right? So in many ways, and I think Warren Buffett and Charlie Munger describe themselves as learning machines, right?
Yeah.
And that learning machine aspect of this is, I may not know anything about computers, or I may not know anything about semiconductors, or I may not know anything about women's fashion, right? But I go learn about it and identify those things, and that helps me become better at the valuation component of this.
Yeah. I think we trailed off here into different realm, but certainly very important topics right there you just touched on. Anything else you want to add to this topic of price to free cash flow before we close it off?
No, I think what I say in this caveat, we've talked about before. If these are concepts that you're struggling with, after the Christmas holidays, Becco and I are actually going to start evaluating real companies using this checklist and using valuation measurements. I think that'll help you understand this a lot better. It certainly makes it easier for me to do, because right now we're just talking about it in abstract concepts.
Right.
When we start doing it with a real company, I think it'll be much more useful.
Yeah, for sure.
And we'll have real world examples for you to follow along with.
Mm-hmm. Yeah, absolutely. I'm very much looking forward to that next year. So, okay, so that is episode 29, Price to Free Cash Flow. Thank you guys for listening, and I will see you guys on the next episode, episode 30. Thank you.
Thanks.